experience. So recording is being taken. And if you're joining us again, you may be familiar with how frequent we do a market outlook. Typically, we aim to do these at the end of each quarter to reflect, but also look forward. And we thank you for allowing us to be the trusted people, the trusted voices that you're hearing and seeing throughout all the chaos that you may be hearing and seeing elsewhere. So we don't take it lightly that you're here with us this evening. We greatly appreciate your presence. A few other housekeeping items. We will be monitoring questions and answer. For those that have RSVP'd, you may have already submitted a question beforehand. So we're going to do our best to address those throughout the conversation. But we're going to try our best to keep it time limited. And our hardest task is taking all this complex information, all this data, all this numbers, and presenting it in a very easy to understand way. So we're excited for the challenge. We look forward to it. And again, grab your snack, grab your drink. This is going to be a great experience altogether. Before we kick off, Emmett, anything from you?
Yeah, I mean, the big thing, like Marcus said, is that, typically we do these once a quarter. And, for the prior sessions that we've held, we've always had some type of guest speaker. So Marcus and I decided to kind of take the bull by the horns with this one. And we wanted to bring you the content, that we know that you need, given just how dicey things are out there right now as well. So the info that we have, is going to be pretty technical, but we'll, as Marcus said, do our best to break it down in easy to understand terms as well.
So with that being said, perfectly everyone on the screen can see the beginning of our slide, 2023, the second quarter outlook. Our theme here is preparing to land. So when you hear preparing to land, I know what comes to my mind is typically a plane, right? What would the landing be? Prayerfully, we've all experienced a safe landing, right? Nothing too bumpy, but we understand not everything is perfect. You may experience some turbulence along the way. And some things that may disrupt the smoothness of that experience. Three things that we're going to be keeping an eye on are, one, inflation. Inflation is really going to drive the Fed or determine a lot of the Fed decisions in their policy to try to tame the high inflation that we've seen over the past year, 2 years. And in the end, we know that there's going to have an effect on the economy. So the three main things we're looking at or keeping an eye on will be inflation, the Fed, and the economy. So starting off with inflation, good news, inflation is slowing. Unfortunate news, may not be slowing as quickly as the Fed would like and as quickly as we would like. So we've seen, from the pandemic, you can see on the chart, we had a quick shoot up in the price of our goods and services. So the consumer price index, which is a major, the headline CPI that we see, that we follow reports on for inflation. You can see that year over year, it has decreased gradually down to now what is 6%. In the past, we've seen rates as high as 9%. So there are some positive signs that that inflation is decreasing. But when we look a little bit deeper, so instead of just looking at core CPI, but we start to break down the inflation on goods and services. Goods is going to be the bar that you see in the purple, or that bar that you see at the highest. The services is going to be that blue line that you see that has gradually increased over time. So the good thing is that the goods, the price on goods that we use or consume every day, we've seen that drastically decrease in price. Still not quite to the point of where where the Fed would like it to be, but you've seen a slow but gradual increase on the cost of services. So where a lot of that has changed is with goods specifically. Most stores that were sitting on large inventories or prior to, or during the peak of the pandemic where we had supply chain challenges, a lot of those pressures have eased with companies being able to sell their inventory at a discount and prepare for new inventories coming in. So we've seen some price reduction on a lot of the goods that are being consumed, but things like travel, things like going to restaurants, we're seeing a uptick in the cost of services. So on a deeper dive, we know that there's still
And
some adjustments.
just to kind of
challenges there.
add one thing on here as well, Marcus. So what this is showing is just what the year over year inflation rate is, right? So when we look, at like right here at the peak for this goods, that means that from 2022, looking back 2021, things are 10% more expensive, right? And what we're seeing now when, this purple line is coming down is just things are still getting more expensive. It's just that it's at a rate of 4% year over year versus 10% where we were a year ago. So that inflation rate is slowing down a bit. But, we still feel it every single, day when, anywhere we go, things are more expensive than, maybe even the last time that we went to the store. I'm sure that a lot of you are feeling the effects of that inflation on a day in, day out basis as well. So I just wanted to kind of, clarify a little bit. That lighter blue line, services, those, that inflation rate is actually increasing. So that's what that's showing there.
Thank you for emphasizing that. It's a wonderful clarification. So with that, now we're also stuck in a phase where you may have heard Emmett or I say this before. Good news is theoretically bad news, and bad news is good news. So the second thing that we're watching closely is what the Fed is deciding to do with their efforts to try to tame or decrease that inflation, right? So it was widely expected to pause their rate hikes in the second quarter. Much of the reaction in both bond and stock markets have been centered around what the Fed may do. This can make for some confusing headlines. So where you hear positive things like unemployment rate is still low, consumer spending is still occurring and still strong in some sense. Those are good signs, but what that also can caution or create an issue with is that the Federal Reserve may have more room to increase interest rates. So where good news is typically great, it's also bad news because rising rates can also slow down the growth of the economy. Conversely, if there's more bad news, where that may signal that the Federal Reserve may have to slow down or pause their interest rate hike sessions. So when we take a look at the dot plot, this crazy little sheet that you're looking at here, this is just an expectation of what the FOMC, what they're expecting rates to be. So this is a range. And if you're looking at this without getting too carried away, I want you to take a look from your left and to your right and see the gradual decrease of that range. Now the spread, the top dot to the bottom dot year over year is starting to increase, but gradually the middle number is starting to decrease. So currently the range is somewhere between 4.75 to 5%. But the expectation of rates in 2024, you see, is going to generally decrease to a little bit less than 5%. And somewhere in 2025, it's expected that rates may be even lower than that. So to summarize this, it's essentially saying that the FOMC does not expect rates to be high for long. If anything, they do expect rates to gradually decrease over time. So where there's a difference, that's, FOMC is just the Federal Open Market Committee, but investors typically are looking forward as well. So there's two different sides, FOMC and then you have investors. So what investors believe is that the Federal Reserve, instead of continuously raising rates, they actually believe that the Federal Reserve may be cutting rates leading into the end of this year. So based on, some headlines that you may have seen around bank failures and other global pressures that increase or challenge inflation, with all those challenges, especially with the debt ceiling that's currently being debated or at a stalemate, there are some challenges that the Federal Reserve has to keep in mind. And investors are believing that they may reverse course so that actual rates will be lower sooner versus them continuously raising interest rates. So investors think the Fed funds rate will be closer to 4% than where you saw the range of 4.75 to 5.
Yeah, and so just to kind of pick up a little bit on that, when we one of the terms that we've heard a lot about is the landing, right, or landing the plane. And, with the Fed really fighting inflation by increasing interest rates, it takes us really into three potential scenarios. One where we've got a hard landing, right? And if you just imagine yourself being on a plane and you're flying home, you're so happy to get home, and then all of a sudden the pilot just boom, takes you down and you're on the ground, right? You hit the runway and the plane stops, but it just takes you straight down and you just hit the runway very, very hard. That would not be fun, right? So a hard landing, what they mean by that is basically we're heading into a steep recession. Hopefully that's what we avoid, but that's one potential scenario. A soft landing is what we always are hoping for, whether we're on a plane or when we talk about the economy. And that's where, we're flying along and then we just gradually kind of come down and we hit the runway and we hit the brakes and we stop, right? And we safely get off the plane, right? When you talk about the economy, what that might mean is maybe a slowing, maybe a mild recession, but not something that is going to be extremely, widely felt or steep or long lasting. And, the third potential scenario, and we'll kind of talk a little bit more about this as well, is no landing, right? Meaning we don't necessarily head into a recession, but more so it's just kind of a slowing down and we're still maintaining the economic cycle that we've kind of been in as well. So right now, when we look at the chart book that our investment management team here at Cetera put together, what you can see, two things that I'll point out kind of on the bottom left side. Recession riskometer doesn't take an economist or a genius to say we've got a high risk of a recession right now. So you can definitely see that with all of the data that they've aggregated together, there is a high risk that we either are in or are heading into a recession. Also, economic trends are signaling a little bit more negative. And that includes looking at everything from the labor market, job market, all of this kind of pulling together. So what does that all mean as far as where we're at? I won't say that, and nobody will, guarantee that a recession in 2023 is inevitable. In fact, the Atlanta Fed right now is projecting second quarter growth to be near 3%. And that's, on the higher end of estimates out there. You can see, there's certainly a range of estimates. But, one thing that we have noticed is that the consensus is trending upward as well. So we're starting to see folks, we're starting to see the economy and GDP start to kind of trend back upward, into that, maybe, 1% year over year number. Of course, like we said, Atlanta is estimating that a little bit higher. So we'll go through those three different scenarios here. First scenario being the hard landing. And this is kind of the bear case. This would be, a deep recession, definitely due to, stubbornly high inflation. We've seen the Fed, fighting inflation, like I said, with hiking interest rates, and it's been very, very aggressive. This is what has kind of caused some of the issues with the bank failures that we have seen so far year to date as well, is these interest rates not only going up but going up so quickly. So when we look at some of the different metrics to gauge inflation, it's not just the consumer price index, but we also want to follow this mean CPI, 16% trimmed mean CPI. This removes the top and bottom 8% of inflation categories and averages the remaining ones together. So this allows us to give a better gauge on how inflation can kind of be stripping out outliers at a broad level, right? As you can see, inflation on a broad basis has been rising. And again, it's been rising over the last couple months as well. So It's just a couple data points, but you definitely see the trend is that, bear case scenario could be made that inflation is not under control and the Fed will have to continue to raise rates. We saw today the Fed announced a 1/4 point increase in that Fed funds rate. It's widely expected that they will pause raising rates for the near term, or not increase at the next meeting or next couple of meetings, but it's not for sure. If more data comes back that inflation is just running rampant or anything along those lines, Fed really has no choice but to hurt the economy by raising interest rates to tame inflation. So that is kind of the bear case or worst case scenario. Soft landing scenario, or kind of middle of the road, is that we'll experience a mild recession. This remains what our thesis is as well at Cetera. Inflation's a problem, and we think the Fed rate hikes are going to have an impact, but there's a lag. And as we talked about earlier, companies really, have, depended on zero interest rate policies to fund projects for more growth and essentially, promising or offering investors profits years down the road. This is how so many, technology and growth companies really had huge returns in their stock price and, profits for, the years leading up to last year. They are definitely the most heavily impacted by raising interest rates. The reason is, it's easy to fund future projects at 1%, 2%, 3% loans, but when you start to have to pay 6 or 7 or 8% to borrow that money, it's a lot more expensive and a lot more difficult to do so. The good thing is that a lot of companies out there, especially if you think about not necessarily companies that are new on the scene, but companies that have been around for a long, long time. Not going to mention any names, but companies that maybe you shop at and have shopped at for years and years. They're in pretty good shape. Overall, a lot of those companies have restructured their debt in the last few years. So if they do have any interest that they're paying, it's at a low rate. And similar to how a lot of homeowners refinance their mortgages in the last 5 to 10 years, you may have had a home that maybe you had a 5% mortgage interest rate on. Well, a couple of years ago, you could have potentially refinanced that to a 15 or 30-year fixed rate at 3% or maybe even less, right? A lot of companies did that same thing. So not all organizations, not all companies are going to be impacted by raising interest rates. And, that's kind of what the soft landing would come into play with as well. Third potential scenario is, just basically kind of a no landing or rolling recession. And when we look at just, the number of job openings versus the number of people seeking work, there are 2 jobs for every job seeker out there right now. So, the fact that the labor market is so strong is a great sign for the economy. This goes back to what Marcus said with good news is bad news. We would hear a lot in the fall, especially when unemployment numbers would come out, when jobs reports would come out. Unemployment's low, jobless claims are lower than anticipated, and then we'd have a sell-off in the market because the market knew that means that the Fed is really going to be having to increase interest rates. At the end of the day, the American consumer is the backbone of the economy. People are working. If they don't like their job, they very well may be able to go find a new job. They very well may have also had pay raises. And if they haven't with their current company, they very well may be able to go to a different company and get a higher salary or higher earnings as well. So while this is the case, it's possible that we don't end up in a recession, and the consumer basically continues to spend money and continues to support the economy through this interest increase as well. It's kind of a Goldilocks scenario, but it's possible. That being said, anytime we're looking at the market, anytime we're looking at investing at all, there's always uncertainty, and you want to just kind of keep some of this uncertainty in mind, right? When you consider your situation, when you consider, your portfolio or anything, you don't want to have uncertainty for times that you can't ride through market cycles, right? So think about if there are any large purchases, major developments that you have upcoming, anything along those lines. Eliminate uncertainty for those periods. Let the Fed do what the Fed's going to do. There's going to be volatility during this time period. But if you're looking at, situations for down the road and, whether it's 3, 5, 10, 15 years into the future for yourself or for your family, right? That's where, the market is going to, typically provide higher returns than savings types of instruments as well. Right. One of the wild cards that's kind of leading to some of this uncertainty is China, right? Obviously, there's always questions about what's going on in China, but just to kind of, touch on one thing there, the U.S. and most of the Western world kind of opened up from COVID, in about 2021, maybe 2022, depending on what you consider open. China really didn't open up until late 2022 and obviously had the zero COVID policy. So the reason why that's creating some uncertainty is we don't know what the demand is going to be like in China. And we have a very global economy now. So if there's, a lot more demand in China for goods, for energy, you can see here copper listed, that can really kind of throw things into, a little bit of a loop as well. So something that we're, watching closely is just how that's going to impact everything. Now, when we look at what does this mean for the stock market, in 2022, we saw the S&P 500 sell off by about 18%. And heading into this year, a lot of forecasts were for a volatile, yet mostly flat first half of the year. That being said, you can see here where the year actually started off pretty strong. And when we look where we ended last year versus where we're at the end of the first quarter, or even just a little bit before that, you could see a pretty, relatively sharp increase where the S&P had climbed over 10% in the first quarter of this year, right? So this is why it's important to remain invested, because while there is uncertainty and while there is volatility, we never know when things are going to bounce back. And, we've talked before about missing one or two of the best days in the market can really eat into your returns over the long term. So this is why, we always want to make sure to stay invested as well.
So we take a look at, revisions of earnings and things along that line. If you joined us at the top part of the year, you may have heard us present lower expectations are easier to beat. And if you're looking at this, you can see that the expectations of earnings, which really does drive the value of stocks, long-term stock returns are generally driven by corporate earnings. So when we take a look at what the expectation of those earnings were, you can see collectively for the year, from quarter 1 to 2023 to quarter 4, the total of that return is very low. In fact, we expected negative returns in the first quarter and the second quarter, but it's a low number or nearly single digit positive returns for both the third and the fourth quarter. So where this is an opportunity is if we see a reverse of course, a reverse of path from rising interest rates to cutting, lower expectations are much easier to beat. So if in fact we do see positive earnings growth year over year for these companies, their production, their profits, and so on and so forth, that's going to be tremendous opportunity for a gain in the stock market specifically. So with our thesis of a soft landing scenario, this could provide for upside surprises later in the year as company increase profit margins and inflation starts to fall, and the Fed pauses or even pivots and lowers rates instead of continuously increasing interest rates. But one valuable part to your portfolio is not just stocks, but it's also bonds. And many times we've talked about asset allocation, we've preached balance and diversification. And last year, you might have thought we were a little crazy because that was the worst year that we saw for bonds in history. Bonds collectively, had a total return of a negative 13%. Because you may be familiar with the relationship of bond prices and interest rates. Whenever you have a rise or a change in interest rates, you typically have the reverse effect on the value or the price of a bond. But as a positive, we've also seen bond yields begin to increase as an effect of increasing rates. So what that meant for the bond market is that there's also volatility in bonds equally as stocks. But at this point, what you can see on the screen is that the yield, right, the dividends that you're typically getting from newly issued bonds are much higher than what they were prior to the pandemic and coming into 2021, 2022. But we are starting to see that those are starting to decline at the beginning of 2023. We've actually seen a little bit of a reverse course. So where if there's a move in interest rates, yes, there will be a move in the price, but it may not be as heavily impacted because of the yields that those bonds are paying. So with a potential recession on the horizon, the prospect of a less aggressive Fed, highly qualified bonds can continue to perform well. In addition, if yields do not move from where they currently are, bond investors could get decent yields just from holding on to them. So what this means is that bonds still play a very vital role in your portfolio. It's not something that should be completely abandoned because depending on what your investment strategy is, whether you're looking for protection from a volatile stock market, or maybe you're focusing on income, bonds still play some type of valuable role. But in fact, Emmett and I actually have been taking some advanced strategies of finding ways to provide more protection and risk mitigation. Because again, just because we're investing in bonds does not mean we're adverse to risk or that we're avoiding any type of sell-off or loss. But so there is another asset category, asset class that you may want to consider that can provide some level of protection and still give you a nominal yield as well. So at this point, we will bring it to a close and saying thank you for yet again allowing us to be the trusted voices, the trusted faces that you see amongst all the chaos and different things that you may possibly be hearing and seeing. We do, want to answer any questions that you have, so please take advantage of this time where you have any questions. We did get some preemptive questions beforehand that I believe we will be able to address. But if you aren't able to stay or you have no questions, again, we thank you for your time and feel free to share this information, this experience. We always are looking to enhance our exposure. And feel free to let us know what you enjoy about our presentation as well. We gladly accept any type of feedback that you have. Emmett?
Yeah, one thing that I'll just add there with the bond market volatility, if you go back to that last slide for just a sec. So, historically speaking, when stocks go down, bonds go up. And a lot of the reason why is because, times where the stock market might be selling off, investors might be fleeing stocks and going into bonds. We didn't see that much at all. In fact, there were net outflows both from stocks and from bonds last year. And so as interest rates went up and that drove the price of bonds down, that's where we saw overall the Barclays Ag last year down roughly 12% from January through December. What this is showing is the interest rate that 10-year U.S. government treasuries are paying. And what you can see is that, right now, or at the end of the first quarter of this year, that 10-year yield was about 3.5%, where, a year or two before that, it was much, much lower, right? when we look back in 2020, the 10-year was at about 0.5%. So the amount of interest, and even if we go back, to 2017, 2018, we're higher than we were, at that point as well, right? So, we've got bonds that are paying higher interest now than we had a couple years ago. And the price to purchase those bonds is lower as well, right? There was a drop in the price of about 12% throughout 2022. So what you could do is look at repositioning portfolio, maybe, adding some more into bonds, get a little bit more yield, and, potentially capture some of the price appreciation in the event that the bond market bounces back at all as well. Where could that happen? Well, I think in the event that the stock market falls again this year, if we are in a recession, we do have a steep, drop for one reason or another, at that point, it'd probably be more likely that stock investors would shift over to bonds then as well, which could then drive that price, back up like typically we had seen in the past as well. So this is kind of some nuance in, managing your asset classes, managing how you're invested. The key thing is, if you're able to do that on your own, great, more power to you. If you need help with that, or if you have questions about that, that's what we're here for, right? Most of you who have tuned in tonight, have trusted at least some of your assets to us to manage for you. That's what we're doing, either behind the scenes proactively for you, or, as we sit down and talk, depending on how our relationship is as well. So I just wanted to kind of touch on that a little bit. And again, thank you all so much for the trust that you place in us to be the guiding light and be that resource for you on all of these fronts as well. Marcus, do we have any questions that have come in at all?
None that have come in yet. I think we did a good job.
Awesome. It's either crystal clear or clear as mud, one or the other. Either everybody knows everything or nobody's sure what we said at all. And they're like, I don't even know where to start with these guys. Hopefully the first.
Or you just don't quite know what questions to ask either. Which, Prince, I thought, I know we talked about recession, and honestly, Emmett, there was something that you had mentioned earlier that I think is worth just re-mentioning, especially if anybody's going to be watching this again. Don't lose the value of short-term, medium-term, and long-term. You mentioned investing for certain time frames, right? And I believe that most people, when they have concerns about loss in the market, oftentimes are quickly abandoning the time frame of their investment. So they typically want to make a major decision with a large portion of their assets. And oftentimes that may be the worst thing, but there is some value in making adjustments with a portion of something that you have. So when we preach short-term, medium-term, and long-term, what we typically mean is making sure we have savings, right, for any unexpected emergencies, any expenses that you're planning to use, have, or need in the next 1 to 2 years. Generally, want to have that somewhere, safe, liquid. Maybe there's a good interest rate that we can get on that portion of money. Clearly, long-term can be anywhere, 10 years plus. If you're not just living in retirement or planning for retirement, you generally want to have monies that are positioned to grow, which we do know that stocks are going to do that heavy lifting. But then there's that, anywhere between the next 3 to 10 year time frame where maybe it makes sense to have a more strategic asset allocation, whether you are incorporating bonds or using something like annuities or some other type of structure to protect a solution. They all do make sense, but what balance or what portion makes sense will be dependent upon your plan. So whether we're leading into a hard recession, the soft landing, whatever the case may be, I think now is the perfect time to just remember or re-emphasize the value of short-term, medium-term, and long-term, having that proper balance based on your goals.
Absolutely. That is always so important for sure. So, yeah, we don't want to have, money that we need in a year or so invested in the market, right? Conversely, we don't want to have money that's earmarked for 10 or 20 years down the road and something that's, just, too conservative, right? We need to make sure that we can get, market returns where, market can be used as well. So there was one question that was sent in ahead of time. I'll read this, Marcus, if you want to prepare your material to answer this, that would be great. So question came in. I just saw the Feds are going to raise interest rates another 0.25%. That did happen today. The Federal Reserve decided to raise rates by 25 basis points or 0.25%. Question goes on, if Congress does not vote to raise the debt ceiling and cannot meet payments, how likely will Social Security payments be impacted?
You want to start that off or me?
So, I mean, the key thing is, yes, interest rates were increased. And, it is one thing that we are keeping a very, very close eye on is the debt ceiling. In the event that, we get to a spot where the government defaults on their obligations, the market is not going to digest that very easily. The kind of unfortunate thing with this is that we've gotten pretty used to having to deal with the debt ceiling debacles, right? It's all too often now that, we're hearing about, well, we need to raise the debt ceiling or the government's going to shut down. So in some ways, the market may just take it, kind of in stride. But I think in the event that we do default on our obligations for the first time in history, it's not going to be a good thing, right? So near term, that's definitely a reason for some caution when it comes to investing. How that can impact Social Security payments, typically we would say, don't worry, your Social Security is going to be fine, right? Your Social Security trust fund comes in from a different spot than then the government pays the rest of its bills. So it's a separate pool of money. That being said, Treasury Secretary Janet Yellen did issue a letter recently that wasn't extremely specific, but did indicate that there may be an impact to Social Security payments in the event that we hit the debt ceiling. That's where I'll stop. I can't prognosticate what that means. I can't, give any sort of, percentage likelihood on, how that is or anything along those lines. Personally, I would say, have faith in the system, but it's difficult to do that sometimes, right? So, especially when we, saw the letter that came out from Janet Yellen as well. So there's only so much that we really can talk about with that, of course.
And what I'd say also to that question, whomever may ask it, or if anyone would like to read the article that we came across that I believe really helps in a very helpful manner in terms of just understanding what all that means or what's at risk. We can send that to you on the side. If you ask us, send us an email, give us a phone call. We're more than happy to share the resource that we found. But just some major bullet points from that. One, as Emmett mentioned, to date, there has never been a time where the U.S. Has defaulted on its obligations. So thankfully, it hasn't happened. Of course, anything possibly can. So we have no idea what the future holds. But to this point, there's never been a time where it's defaulted on its debts. When we talk about increasing the debt deficit, there have been plenty of times in history that actually has happened. And much of what this article explains is that there are different proposals, but it just seems that there's not the right or common agreement. Typically, it's just spending here, cuts there that they are generally in disagreement about. And yes, there is a sense of urgency that they should have with making this, but it can go down to the wire as we've seen government shutdowns before. But this is the value of understanding Social Security, as Emmett said. There are some different safety nets in place. One being the reserves, right? No different than you have your regular income, and then you had your savings for that unexpected emergency. There are trust fund reserves for Social Security and for Medicare that if obligations are not met, those resources can be utilized or exhausted. And then there's also a law that they mentioned that could come into play called the escape clause. It is a form of a 1996 law that allows the Treasury Department to pay Social Security and Medicare benefits, even if there is a delay in rising the debt ceiling. So it's very concerning the time that we're in. But I can say historically, this isn't the first time that we've ever had a disagreement on the increasing or the adjustment of a debt ceiling. And there are safe nets in place, but what happens was, we'll just have to wait and find out, unfortunately. So again, allow us to pass that information along to you if you have that question. Take some time and identify whether, this would be a major impact or what other resources you can have as your safety net as well. Any other questions that you got, Emmett, or I didn't see any else in the Q&A?
I did not see any other questions. It looks like we did just have one come in. What impact might the market have after the Social Security trust runs out? I thought it was estimated to run out in 2035. So great question there.
Great question.
That's very difficult to prognosticate as well. It is, I believe, set to be. It's fully funded through 2035. That means pay all claims through 2035. And without any reform between now and then, basically, the tax revenue that comes in for Social Security would be funded to pay 75% of claims beyond that point. What would the market impact be? I can't imagine it would be great in the event that the trust fund runs out and, we're facing all the millions of Americans relying on Social Security facing a 25% pay cut. Can't imagine that would be great at that point, but hopefully we don't get to that point. And hopefully we're able to, have some meaningful reform between now and then as well. And for anybody who is on Social Security who may be listening, typically when there would be reform on something like that, it wouldn't impact people who are currently drawing as much as it would impact future generations, future beneficiaries. So, yeah. Chances are the baby boomer generation, I think they call it the silent generation before baby boomers, they would probably not be impacted, but potentially Generation X, Y, Z, whatever they're calling after Z, my kids, right? They might have a bit of a different picture when it comes to Social Security.
And just because I understand that question may have been asked as well, not just for the trust fund reserves, but we also talked about, again, if the debt ceiling is not settled and what the impact may be to Social Security. If you're asking from that standpoint, understand that the default would be more of the, catalyst to any type of market reaction versus, what will happen with Social Security as a result from that. So, as Emmett said, I can't imagine that it would be good, right? So default is pretty significant issue or consequence. So I just have faith that there will be something done in a timely fashion to make sure we don't default, at least.
Right. Awesome. Well, it's been, as they say, it's been real and it's been fun, but it might not have been real fun. All right. Thank you all so much for joining us this evening, and we look forward to continuing to help you with all of your investment and market related needs. Thanks.